All right, we're live. Welcome everybody to the first BitGo and Figment institutional staking webinar. Go ahead and give you guys just a couple minutes to fill in the room here. If you guys want to just go ahead and let us know where everybody's coming in from, or you can go ahead and fill out some questions you guys may have coming in on the chat. We will have time at the end to go over any questions, a little Q&A. But feel free to go ahead and throw them in the chat whenever they come to your mind. All right. Guess we can just go ahead and start then. Oh, yay, there's a chat. Awesome. Love San Francisco. Nice. Awesome. Ooh, we got almost worldwide here. Ooh, there it is. We got somebody on the other side of the world. All right. So while we're all here because staking and Web3 are really hot, and I'd like to start off with kind of a quote from James Baldwin. Know from whence you came. If you know from whence you came, there's absolutely no limitations to where you can go. So with that being said, there's really only two things I want you guys to take away from this entire talk. And that is why stake and why custody. And that's really it. This agenda kind of looks a little bit daunting, but that's pretty much it. And to get us there, I'll frame it with, where we come from. So with the first iteration of the internet, we had Web 1, which can be thought of as a view-only internet, where users could just view static websites. This added tremendous value to the businesses that use them, but it was also limited in how it could transfer information. The current stack of internet is made up of several different protocols that facilitate how data is used, transferred, stored, and accessed online. With the advent of Web 2, it wasn't so much the addition of a protocol, but more of a front-end revolution. So the developers were really changing how they designed the sites and how users interacted with the site. And from this, we got the participatory internet. And you can think of great examples here like Facebook, MySpace, TikTok, all of these like social media type platforms. And you can see with each iteration of the internet, we had huge transfers of value. With Web 3, it's not so much as a front-end revolution. Not much is going to change on the front end of the internet, but the entire back end of the internet is being revolutionized. With the addition of these protocols that we're adding with Web 3, mainly blockchain, we're allowing the transfer of value between two people who may not know or trust each other, and without the need for a middleman or a fiduciary. That sounds great, right? So like, how do we take advantage of this new ownership internet? To speak more about this, we have Daniel from BitGo and Allison from Figment. Daniel, would you like to tell the people a little bit more about yourself?
Awesome. Thank you, Chris, for the introduction. Very well done. Hello, everyone. My name is Daniel Du. I'm a product manager at BitGo. I oversee our blockchain integration, specifically staking, opening it up to all of our customers, opening up for both hot and cold storage wallets, and I'm excited to be here today.
Awesome. And Allison, would you like to let the people know a little bit more about yourself?
Hi, everyone. I work with our asset management clients at Figment, so crypto native or TradFi, helping them integrate staking into their portfolios. And prior to coming to Figment, I spent 10 years in traditional financial services in private wealth channels at 2 large investment banks.
Nice. And now that we know who the people are, and myself, I'm Chris. I work with Figment Marketing, and I'll be the moderator today. Not so much of an important one here, but you'll be hearing my voice a lot here. Well, now that we know who will be speaking, Daniel, would you like to tell us a little bit about BitGo and what BitGo is trying to accomplish?
Yeah. So overall, BitGo is the leader in digital asset for financial services. I don't want to kind of read through the slide, but ultimately what we're trying to do is be the qualified custodians to all of our assets for institution, exchanges, and anyone who wants access to crypto and Web3. We help power a lot of these clients, and most importantly, give them a secure way of custodying their assets, opening up the ability to do staking, DeFi, and many of them use BitGo primarily to make sure that their digital asset is secure and they could use it for whatever crypto means and methods that they need, exactly from our platform.
Awesome. It looks like some people have some sound issues.
Shall I repeat?
No. Well, some. Okay, so some have fine audio. Maybe it's a try refreshing the browser or something. All right. No issues. Okay, we'll just continue and hopefully we can
I'll
catch
speak up next time. Speak up more.
So we're gonna same question to you, Allison. What is Figment aiming to accomplish?
Yeah, so Figment is an institutional blockchain infrastructure company. And we do a few things. We're probably most well known for staking. So that means we provide staking services to institutional token holders and a suite of services around that. And we currently support 60 different networks and growing. And then we kind of take an ecosystem approach. So we do a few other things in addition to staking. So we support the developer community with our node infrastructure and suite of APIs, and really helping developers transition from building in Web 2 to Web 3. We are also core contributors on the Graph, which is an indexing protocol. So we really look to support the token holders, the blockchain itself, and the infrastructure, as well as the developers building in the space.
Awesome. So now we know the people here and what we're aiming to accomplish. Now, why should we stake? And I could sit here and give you guys a whole laundry list of reasons to stake, but I think you might get a little bit more value if we talked about why we personally stake. Allison, why do you stake?
Yeah, so to cut to the chase, and as somebody that spent 10 years in financial services, the yield is really, really attractive. So assuming that you take at least an intermediate to long-term time horizon, and by intermediate, I mean a few weeks, so you're not day trading, you are quite literally leaving chips on the table by not staking your tokens. Additionally, there is an inflationary component of the yield. So if you're just holding your tokens and not staking them, you are actually eroding principal. So the yields are quite stable and attractive, particularly when you look to other areas of DeFi. Second is, I think that there are very few investment opportunities in crypto and even outside of crypto where you can truly shape the direction of the network. And the fact that when you stake your tokens and can participate in governance, I think it's just a very cool how participatory it is from both a retail user perspective. So you can stake like essentially as little as one token, to, as we look towards institutions, of how they can also participate in governance. I just think it's really interesting.
And I'm going to flip the same question over to you, Daniel. Why do you stake?
Yeah, I would definitely, all the points that Allison brought up, I would definitely echo it. I come from more on the product side. I've worked in fintech for a number of years, and just the accessibility that this gives to the average retail users from a technology standpoint is awesome. That not only can you get some kind of more consistent yield, but you could also help shape the direction of it from a technology standpoint. It's never been done before. Traditionally you have to go through some central entity or work with some board of directors to do this. So having that ability to do it yourself and decentralize is a big selling point. And personally for me, I'm very big into AVAX staking. So anything that could give you some kind of consistent yield to not only fight against inflation, but give you something that's very durable yield is always something that I look forward to, and why I personally stake as well.
Yeah, these are a lot of the same reasons why I stake. For me, it's really, this is how you own and you participate in the ownership of the Web3. You can hold your tokens and really just wait for price appreciation. But like Allison was saying, you're losing some of your assets with inflation by not putting them to work for you. And on the flip side, for me, I'm really big into governance, and I like the fact that by staking my tokens, I now have a voice in the direction of the protocol. And I think that there's just a tremendous amount of value that can be accrued through good governance and participating in that. I like what Tim asked here. He's really contrarian here on the flip side of the coin. He says, why wouldn't someone stake? And I think Billy Joe here kind of really answered the question for him. Is there are lockup times for each protocol. I'm hard pressed to think of a protocol that doesn't have a lockup time for staking. But those would be the reasons why I would see that you wouldn't necessarily want to stake. If you need the assets to be liquid, then you probably don't want to stake them, because you do have unlocking periods.
I would say ahead, for like very heavily oriented trading clients, so some hedge funds, it doesn't make sense to stake at least a large portion of their portfolio if there's a lot of turnover. But really, for VCs, for most asset managers, assuming you can get comfortable with a little bit of illiquidity. So the illiquidity ETH aside is generally, 2 days to 28 days on the long end. So assuming you're comfortable with that period of time, like there are limited downsides. I mean, there are some risks associated with staking as we're describing it. And we'll get into that a bit, but compared to other areas of yield, of how you can source yield in crypto, it's quite stable and secure.
Oh, great question.
Yeah,
for
why
Michael
don't we,
here,
so Michael, we will answer this in a few slides, but not in protocol staking, yes, in DeFi staking.
Exactly. So we know why to stake a little bit. Now let's talk about what is staking for those that may not know in the room. And this kind of goes into Michael's question a little bit. Would you want to take this one, Allison?
So the reason why we're defining it is because staking is just ill-defined in this world. So like, this is how I think about it. Someone or something has to maintain the ledger on any given blockchain. And you have Bitcoin, which uses the proof of work consensus mechanism, or mining. And most people are familiar with mining, at least at like a surface or face value. So, maybe you've seen pictures of mining rigs. Maybe you've heard that it's energy intensive, and it is. But Bitcoin is essentially secured by computational power and energy, and it's done by miners. Staking, on the other hand, actual individual token holders are the ones responsible for maintaining the ledger. So how it works is you stake or lock your tokens onto the network, and this gives you the right to essentially serve as a validator and verify transactions, and then you are compensated for doing the work in the form of yield. So if you stake your ETH on the Ethereum blockchain, which Ethereum is progressing towards proof of stake, then you're going to earn ETH. If you're going to stake your Solana on the Solana blockchain, you're going to earn SOL. So that's your compensation for doing the work. And in addition to the compensation, you get to participate in the governance, as we talked about earlier.
Awesome. So what I'm hearing is you're securing the network, and for doing that work, securing the network, you're rewarded with new block rewards and transaction fees on the network, split between you and the validator.
That's right. So you earn inflation and transaction fees, and unlike some other areas of DeFi, which again we'll talk about, the yield is very stable and predictable. So as you're looking to incorporate it into your portfolio, particularly if you're an institutional portfolio manager, a hedge fund, a VC, you need to understand where your yield is sourced from. You need to understand how it's going to be impacted by the current environment, which, like, little inside secret here is like staking yields actually have not moved meaningfully despite this volatility that's going on around us. So it is a very good place for portfolio managers to go, of all shapes and sizes, to secure yield.
Did you have any color you wanted to add to that, Daniel?
No, main color I want to add to that is kind of going along the line of the durable and stable yield, also minus ETH. ETH is one of those very particular staking blockchain, which we could get into later, but most of them have a pretty short lockup period, minus ETH. ETH is a bit indeterminate. But when it comes to slashing as well, many don't have a slashing. And the whole idea of locking up your funds is kind of the network saying that, hey, you help secure the network by locking up funds and you get rewarded as such. And not only that, you don't really run into the other risks that you see with DeFi when it comes to impermanent loss as well.
And that is a perfect segue into common misconceptions and risks with staking.
Yeah.
So in Web3, we really have a naming problem where we kind of just call anything that generates yield staking. Would you like to give us some color on what are some common misconceptions that you see on like the Figment side? Allison?
Yeah, so everything we just described is pure protocol staking. So serving as a validator, maintaining the ledger. I will say, again, there are risks associated with everything. There's no free lunch. The risks associated with protocol staking are, remember, your tokens are locked in the network. So I think of it as like the network is actually your counterparty. If you were to either have faulty infrastructure or be a malicious actor with your validator, the network could say, hey, we're going to punish you for causing confusion at the network level, and we're going to remove a portion of that principal. So that is called slashing risk, principal loss. And it varies, the penalty varies by network. And some networks, as Daniel said, like haven't even really fully implemented slashing penalties. But know that that is the main risk associated with staking is slashing or potential loss of a portion of your principal. And any good staking provider should take measures to mitigate that. The second, which isn't really talked about as a risk, is this illiquidity, which like I don't want to beat a dead horse. Like we've talked about it. So you have to be comfortable knowing that you can't trade in and out of your staked tokens over some length of time, protocol dependent. So you just have to be comfortable with that risk, particularly in volatile markets. The other side of staking, which is actually probably becoming more, I think when people hear staking, it's almost where they first go, is this DeFi staking, or essentially pooling your tokens and providing liquidity, lending, borrowing, transacting. And there are an additional layer or additional sets of risk, both financial and technical, that can occur in this sort of like by providing liquidity. So on the financial side, there's things like impermanent loss, which that is relevant in DeFi staking. You have some counterparty risk. Then you have things like on the technical side, smart contract risk, because you're actually depositing your tokens into a smart contract. Unlike protocol staking, where using BitGo as the example, like BitGo has your keys and then the network has your tokens, there is a chance that there could be a bug in the smart contract and you lose funds. And then I think, what is super relevant now is the lack of transparency, perhaps centralization that's gone on in some of these DeFi protocols, and how quickly that can unravel. And, so there are all these other factors that you have to take into consideration when you're doing DeFi staking. My perception is if the yield is too good to be true, it's too good to be true. And so like you should use that as your guide when you are considering the investment landscape. I want to touch quickly on Tim's question in the chat. So he mentioned, is yield inversely and liquidity inversely proportionate? And no, it doesn't work like bonds, like the price yield relationship. It's really, what drives yield is sort of how many validators are on the network, as well as like how new is the blockchain, because essentially each network will incentivize people to come in to stake with a higher yield if it's a newer blockchain and they need more validators to secure the network. There are a few factors that go into play and drive yield.
Yeah, I do want to touch on the key, who holds the keys, because to what Allison said, when you do protocol staking, you or whoever has the wallet, you they are the only one who holds the keys to now staking. When you see these like smart contract DeFi staking, typically whoever has control over that smart contract, they will be the one who has full control of it. So if they ever went away, your funds are kind of lost. And another misconception I also want to bring out, because this is something I hear quite a bit, is around staking and delegated staking. For the most part, if you're not a validator, oftentimes people use it interchangeably, but staking, there's a few components to it. One is you are the validator yourself. Oftentimes there is not only a minimal amount that you need because you're running the actual servers, the actual hardware stuff to validate, but the whole idea of proof of stake is, because in proof of work, the whole idea is no one has over 51% of all computational powers to maliciously attack a network. With proof of stake, the kind of idea is no one has over 51% of all the funds enough to change the direction. And sure, some of the newer blockchains, if they're new from their genesis, might be small enough to like completely change it with some whales, but by and large, most of the blockchains that are more stable and out there, the whole idea is proof of stake means no one has more than 51% of the funds to do it. And to do that, to be a validator, you need a good amount to be even allowed to be a validator. And depending on the protocols, will be different. So if you have the minimal amount to be the validator and have all the necessary hardware requirement, which is quite complex, which is why Figment is one of our awesome partners who manages it, that's to be a validator. When you're delegating, oftentimes most people don't even have the minimal amount nor the hardware requirements to do so. So you could delegate your funds over to a validator and have them effectively or send it over to them to help secure the network without having all the necessary hardware or minimal amount to do so. The rate will still be the same, but it'll be proportional depending on how much you stake. So, it allows a lot more people to have accessibility and to help secure the network without having the necessary minimal amount or the hardware requirements to do so. And in this model, you also still have full control over your keys to stake, unlike other protocols where they might actually pull your funds into a smart contract or to a central entity. Those are a little different because it allows you to further go below the minimum, but you run the risk of some other party, third party, holding your keys, and you're giving them more control over it.
So
I think that's a big misconception I run into a lot with some of our clients.
Yeah, that's great color, Daniel. I also would like to ask, because since we're talking about keys here, this is one of the bigger differences than staking, as we're talking about it, protocol staking or vanilla staking, than to some of these DeFi risks where you're actually sending your tokens into a smart contract and you're giving them up, so to speak, and they're being controlled by that smart contract. With custody and with delegating, you still own your assets, correct, Daniel?
That is correct. So when it comes to actual delegated staking, you will have full control over the funds. And even though it might look like you're sending some kind of transaction or sending some commands, more technically, over to a protocol to do staking, you will always have full control over your assets, where if the protocol itself or the validators themselves ever go offline or ever goes away for whatever reasons, you have the ability to unstake to get the funds back, even though the validator might not be active. Whereas for maybe pooled staking, as I would like to call it, that third party, they will be the ones who has full control over. So if they ever go away, you need to go offline or hit up your lawyers, hopefully not, to help deal with that scenario.
So in that sense, protocol staking is the least risky yield generation in Web3?
That's correct. You would always have full control of your keys, always. The yield might be smaller than what you oversee, but as Allison mentioned, if the yield seems way too good to be true, you have to consider it might be true, right? The rates might be super exorbitant, but then you have to ask yourself, what are the risks around it? Like, who holds the keys? Who's actually managing the actual yields? How are they getting the yields? These are always good questions to ask about, not just staking, but any kind of yield generation products out there.
Amen. So I'd just like to end this last one here. My favorite saying in crypto is, not your keys, not your crypto. And then second is, if you don't know where the yield comes from, you are the yield. So with protocol staking, we know where the yield is coming from because it's clearly defined and it's very transparent and open. So the risks are easier to mitigate. So while we're talking about common misconceptions and risks with staking, what is BitGo doing to help mitigate these risks and also empower their clients? What would be a reason that one of our listeners would want to choose BitGo for their custody solution?
Yeah, that's a great question. There's a lot of, I think how I would, not to go too sales pitchy, but for BitGo, we are one of the leaders in digital assets custodian. The whole element of us is we are effectively a very secure, both hot and cold wallet provider. Effectively, at the end of the day, whether it's through our UI or API, we give you all the tools while maintaining secure custody of your keys. Ultimately, as you mentioned, not your keys, not your crypto. We make sure that all your keys are secure. They're held in cold vaults. So whenever you do any transaction, you have full faith in knowing that your transaction is secure, no one could hack it, and everything is from a secure, qualified cold storage. Not only that, some of the fun facts I always like to tell people is when they ask, why choose BitGo, we were one of the first pioneers to create multi-sig transactions. So not only, because one of the risks around crypto is if you lose your keys, it's very unfortunate and you're kind of out of luck. With multi-sigs, not only can you have approval process, so others can also, so we shard your keys that it's not just one single point of failure, but you could spread it across others in your organization. And not only that, we have cold storage, so it's never online. No one can ever hack it. We have a secure vault, physical, literal vault that houses your keys and crypto.
Awesome. Speaking of hot and cold wallets, do you guys use a mix of both, or do you prefer one or the other, or is that up to the client?
It's definitely up to the client. We try to provide, we want to build a unified solution for the Web3 economy. So whether you're an exchange that needs quick transactions, so a hot wallet would be more suitable for you, still secure. But if you're more of a VC long-term holder where you want to just park your assets to make sure it's very secure because you have a large amount of it, a cold storage solution would be more ideal in that case. But either way, we offer staking from both hot and cold. So whether you want to stake some assets as an exchange from your hot wallet, you could do so, or from cold storage as well. For hot wallets is a little less ideal because, as we mentioned, if you're dealing with large volumes of transactions on a very quick basis, staking might not be ideal for you because, as we mentioned, there is some unbonding period. Some could be as short as a few days. Others can be, I know Polkadot is 28 days. So depending on your capital management and liquidity ratio that you need, staking might not be well suited for those who need high volumes of transaction. But for more long-term holders where it's more infrequent transaction, cold storage staking would be more ideal in that case.
Okay. And just for some clarity, people aren't staking with BitGo, correct?
That's correct. So from BitGo, you'll be initiating the delegate staking transactions, but we'll be using staking partners like Figment to actually pick up these transactions and validate on your behalf, and then send you a portion of, or send you proportional to how much you staked as a reward back.
So it'd be better for people to think of BitGo as security on their wallet, or like a bank.
Correct, because they even interact with these a little bit like a bank. Well, banking, which you go into, that has a lot of regulations and rules around it, which can, no worries. But as a custodian, since we're a crypto custodian, at the end of the day, we are a secure wallet provider. To interact with anything crypto, wallet, as I like to say, a wallet is king. Without the wallet, I think nowadays, after a few years being crypto, wallet, I think the easiest ways for a lot of people think of interaction with crypto and blockchain is using a wallet, digital wallet. But ultimately, a wallet is king because it is your access into crypto, into Web3, where without some kind of browser connection or wallet, you can't interact with this. So here at BitGo, what we try to provide is a very secure wallet solution so you can interact with not only staking, but DeFi and everything and anything in the blockchain world.
Yeah, it kind of speaks to the whole, you could do it on CLI, but what kind of user experience is that? So wallets are valuable.
Precisely.
And, we got another one. Does your hot wallet platform have an API integration capable with digital asset accounting subledgers?
Yes, we do. So all of our products have API connections. So sorry, does your wallet perform? So yes, so there are other partners. So we ourselves don't do the accounting subledgers, but we have interactions that with other partners who does specific sub-ledger accounting, or if you have the technical chops of building your own ledger, you could connect to our both hot and cold wallet APIs to enable this kind of use case.
Awesome. So for Derek, I hope that answered your question about the difference between like, we're not really staking with BitGo. BitGo's keeping your token safe while you are staking. And that kind of leads us into, why would someone want to choose Figment, Allison? Why would you want to delegate your tokens to Figment opposed to other validators out there?
Yeah, so I guess I'll hit on two things. So risk mitigation. So the technical infrastructure to greatly reduce risk, including slashing, as we discussed. So we've never been slashed in our history. Making sure that there is slashing coverage, which Figment has to compensate you to the extent that there were to ever be a slashing risk, all while maintaining really good uptime or essentially performance. Second, on the risk point, and not to be underestimated, is like the governance. So like, we're truly stewards of your capital in that we can drive the change of these blockchain networks. So I think that people, like I did, like immediately go to the financial incentives, but the governance is not to be taken lightly. So do you know your validator? I mean, even if they have great uptime, are they good stewards of these networks? And can you sleep well at night knowing that they're going to make good decisions on your behalf? Or are they going to help you make the decision that is best for you, because you can vote directly as well? So I'll like kind of categorize that into risk and fiduciary responsibility. The second point is really like, we make your life easy. So I think if you've operated in this space for any period of time, you know how hard it can be to do seemingly simple things. So having an account manager or somebody where you can actually call and talk through how you're going to implement staking and how everything is working out for you is really important. Reporting, right? Like month-end reporting and real-time reporting. Who would have thought that that is really, really important to people? But it is becoming increasingly important. The governance piece. So we have protocol analysts that all they do is spend time focused on these networks so they can help you make informed investment decisions. And then finally, I would say just everything else that we do in the ecosystem, the fact that we support developers, that we support the networks. If nobody is building on these networks, it's not good for any of us. So kind of this ecosystem approach, I think, makes a really powerful combination.
I want to throw out, as a partner with Figment, the whole idea of being institutional, especially since BitGo, we are institutional custody solution. Having a partner like Figment who does think about that upfront and center definitely makes it our lives a whole lot easier to integrate with Figment to allow staking for our customers.
Yeah, and similarly on BitGo, right? We're non-custodial. So as we look to work with institutions, they need to know that their keys and tokens are safe. And so, you know, that's why we choose to partner with BitGo.
And Allison, you mentioned reporting. Does Figment offer like rewards reporting to make taxes a little bit easier for people to
Exactly. To do? Full disclosure, we do not provide tax advice, but your operations and finance team will love you.
Awesome. And that kind of brings us to why custody and stake. For me, you know, it's as simple as this. Like, you have your assets. The first thing you're going to want to do is make them secure, because if you lose your assets, you don't have your assets, right? And that's where custody comes in. And now once you have your tokens secure and they're safe, you're not going to want to just have them sit there and just wait on price appreciation. You're going to want to put them to work for you. And that's where staking comes in. Would you like to give some reasons why you think custody and staking go together like peanut butter and jelly?
Yeah,
Allison?
I will say, and I meet a lot of people sort of in like all stages of their crypto life cycle. Like it's very much like step one and step two, right? Like the first piece you need to get right is custody. And then the second piece you want to do is like, how do you make your capital more efficient and increase returns? And then there's many, many steps beyond that in the crypto journey. But I think that these two are just like the natural, like they're very natural starting places for people as they're looking to invest in the space.
And Daniel, can people still participate in governance if they have their tokens custodied and staked through you?
Depending on the blockchain, it'll differ, but definitely for sure, because the whole idea of governance is that since you put up some funds to stake, you literally have stake in these protocols, and if they're good protocols, they want to decentralize the direction of where the blockchain is going. They want to incentivize or reward people for not only securing the network, but they want people to have a part and drive it. So once you stake in cold storage, it allows you to not only get the yield, which is kind of first and foremost of why people think they want to stake, but also to help drive governance, help drive where the protocol should go, talk with other folks to understand where they're coming from and help just drive where they want to see the protocol go, which is a new paradigm shift that we haven't seen since ever.
Right. And on another note, like, why custody and stake? If you still have your assets, or maybe you haven't bought in yet, this is a great time to buy in. Probably everything's on sale, so we're looking at awesome.
Everything's
on sale.
Yeah, but everything's on sale. But with crypto, it's not like banking, as you mentioned, where things are insured. Like if you were to get a MetaMask or some Wallet Connect and Hot Wallet and try to stake, it's very easy to do so. But the security around that is not 100% secure, right? You might lose your keys, you might get hacked. But at BitGo and as a custodian, not only do we help encrypt your keys and manage it for you to make sure it's very safe, you could shard it so you don't have a lot of, you don't have a single point of failure. But not only that, as a qualified custodian, we also have insurance on our I forgot to mention, cold storage solution as well, up to $250 million. So in the very, very rare case where something goes wrong for whatever reason, you could be kept sound, or you could sleep soundly knowing that your crypto will be insured up to $250 million in cold storage.
Awesome. And I think that kind of covers Billy Joe's question he just threw out there.
Yes. To Billy, yes, it does. The staked assets themselves will be covered under insurance. The reward amount will, if it ever gets slashed, that's where we also have coverage.
And Allison, is there any type of insurance or way for people to be made whole through that may stake large amounts of tokens through Figment?
Yeah, we have slashing coverage, and our sort of infrastructure and track record speaks for itself. So even without that, I think people should feel comfortable working with a provider like Figment.
It's a great question, Wiki. Allison, would you like to take this one? And then same for Daniel for each of your perspectives?
Yeah, so we work with third-party providers.
Same. We have both the off-chain and on-chain third-party insurer provider.
What's better than one level of insurance? 2 levels of insurance. Love it. All right. And I just want to kind of close this out with, it's our belief that Web3 has a really bright future, and Figment and BitGo together are really focused on bringing up the whole Web3 space. And this is why custody and staking go hand in hand, especially as a large token holder. It may not be all of your funds. It may be other people's funds as well. So it's really important to make sure that these funds are as secure as they can be when participating in something that can be as risky as crypto. And with that said, I would really like to open up the floor for anybody that has questions. Or Allison, Daniel, was there anything else you guys wanted to throw in there? Is this all live? I think I'm alive.
Yes, it is all live. Yeah, so we do have customers currently staking ETH from cold storage at BitGo, and we are open. There's a whole host of all other blockchains that will open up in the coming months.
Awesome. And for Figment side, we've been live, we're live, we're ready to take delegations, and we're ready to hit the next level.
What educational materials would you recommend? So from the Figment side, I can speak to that. We have a whole resource center on our website where you can see, and Chris has put together some wonderful video content too that you can explore via YouTube. So you can go directly to our website to read that. And from a retail delegator standpoint, if you're looking to dip your toe in the water, you can find staking instructions on all the protocols that we support.
I see. Who is your joint solution best suited for? So from the BitGo staking side, since we're offering staking from both out of hot and cold wallets, it's kind of suited for anyone. But I think, as we mentioned, typically for those who don't need to be super liquid, depending on the blockchain, this would be more of a perfect solution for you, where you're more long-term holding. You don't have to transact that many transactions a day, similar to exchanges, where you're just kind of focusing on just holding this assets very securely. This solution would be almost perfect for you because you're getting a yield, fighting against inflation. If liquidity is not an issue, then this is perfect for you. As we mentioned, if you're more of an exchange type customers or someone who needs to deal with a large volume of transaction on a very frequent basis, almost daily, staking might not be ideal. We would almost recommend staking a small portion of it just so you could get some kind of yield out of it. But if liquidity is a big concern of yours, then staking might not be the most suited for this.
Daniel, is there a minimum like USD value that people need to have in order to use BitGo?
No, so we have different pricing plans. We have, I believe, for cold storage custodians, I think you need to custody $1 million worth of crypto to be part of that. Everything below that will have to be kind of talking with sales. I think if you go to the next slide, actually, we have.
Boom.
So you could contact our sales team for more if you're under that, but I think everything above it, that will be the minimum for our custodial product. In terms of the staking amount itself, this will differ based on the protocol itself. But like, for example, for ETH, whenever you stake, the minimum is 32 because for each validator that gets staked requires a minimum, or actually it requires exactly 32 ETH.
Awesome. And here we have a good question for you, Allison. Assuming Figment has no fee and you simply keep a share of the rewards, what does that look like for people who are staking to Figment?
Yeah, so we take a % of the rewards as compensation. And then that just really depends network by network, and it's generally 5 to 10% of rewards.
And they will always have their principal, right?
Yeah, so all of this all happens on chain. So essentially, you stake your tokens, you earn a yield, and the cut of the yield, whatever that % is, goes to Figment, and your share goes to your wallet.
Awesome. And then same question to you, Daniel. Are there fees or percentages for using the custody service?
Yeah, so on the custody side, it's based on an asset under management fee structure, where based on how much assets you have, the fiat value, we take 1 or 2, or depending on your pricing plan, we'll take some basis points out of that.
Awesome. Okay, this may be for you, Daniel, but what does your process look like for the selection of supported staking assets? How do you guys choose what to support?
That's a great question. So we do kind of a top-bottom approach, where we look at which staking protocols, either have the most market cap in terms of a stake, or both, who has the most, what is their total market cap size, what is their staked market cap size, total amount of staked value, and then we kind of factor that in to see, who's the biggest, and kind of use that as a starting point. Next, we kind of go into who of our customers want this. Some customers might want Solana, some want DOT, somewhat AVAX, and kind of based on customer demand, we also kind of further prioritize what we want to add. The next step, we kind of factor in complexity of how much time it needs to integrate these protocols, and then we look at the ecosystem. Once we onboard it, what else can further come out of it. You have chains like Avalanche, where it's this multi-chain blockchain where you could not only build your own tokens on top of it, but it has this multi-chain elements to send funds within the blockchain itself very quickly, very seamlessly, very cheaply. So we kind of factor all these priorities together to figure out which we want to prioritize.
And if people wanted to know what tokens you currently support, where can they find that information out at?
That's a great question. You could either contact us or you could go to bitgo.com, and we have a section about all the assets that we support, as well as what staking assets we support as well.
All right. And
what?
Yeah, you want to take that one?
Yeah, there are other custodians out there, but I would say what makes BitGo stand out from the others is not only just the amount of assets we support, because other custodians also support a wide variety of assets, but we are a qualified custodian, which means that we have a South Dakota trust that allows us to be a qualified custodian. So if you're a regulated entity, because crypto is an unregulated assets, you would need a qualified custodian to hold it on your balance if you want exposure or access into crypto. So we are one of the few that could only allow you to do that. Not only that, we pioneer multi-sig. So not only are we a qualified custodian from a regulation perspective, from a technology and security perspective, we have our multi-sig solution that, as we mentioned, that gives you full confidence that your assets will be very secure in our wallet solutions.
Well done. Awesome. Do we have any last burning desires or questions? Did I miss any questions? Awesome. Well, thank you, guys. Do you guys want to give any closing remarks before we end the call?
Yeah, I'll start. I hope everyone dips their toe in their water and takes sort of a long-term approach to the space, and sort of is being very thoughtful with where they're spending their time, but know that we'll get through this volatility like we have in the past.
I would definitely echo that. I think, people say we're going through a crypto winter, and that's probably true, but this is an exciting time where you could see kind of the very secure ideas, win out. And some protocols will fail. That's just kind of statistically that's going to happen. But this is an exciting time to see the ones who have a very secure, very stable idea. They will be the ones that win out and give confidence to not only the crypto ecospace, but to the larger mainstream audience. I think all eyes are on us now, and it's an exciting time for the ones who have a solid idea to really show what we can do. And one other thing I would like to point out or to add as a closing remark is, in crypto, things can be very complex, but I think the best way to learn is, as Alison mentioned, is just to dip your toes, get a MetaMask, try staking, try it out, see if this is for you, see if it's for your clients. And if you guys ever need any questions or help, we're always here.
Awesome. And real quick, Alison, is there any alpha that you can leak about M's question here?
Yeah, we actually we announced with Coinbase Cloud the launch of our ETH liquid staking solution, which will be live here, later this summer, early this fall. I can certainly share the press release, and then there will be more details to follow.
Awesome. And I know for a fact at Figment, we are hiring Derek. Not sure if you were asking Figment or BitGo. Are you guys hiring BitGo?
We are for select roles. I think, again, if you go to our website, we do have a contact us and a hiring page as well.
Awesome. Well, if that is all the questions, I will let you guys get back 12 minutes here. Thank you so much for attending, Alison. I really appreciate it. And thank you, Daniel. You guys did a great job. And until the next one, I'll see you guys then. Happy staking.
Take care.
Happy staking. Yeah, thank you. Thank everyone. And I would also like to shout out to our BitGo's marketing for hosting this as well. Thank you all.
Thank you, guys.